Ever wondered how to protect your investments in the volatile stock market? The stock market, as we know, is a roller coaster ride full of unpredictability and volatility. It's like a game of snakes and ladders where you could climb up quickly or slide down just as fast. But what if you could cushion your fall, or at least slow down the slide? Enter hedging, a risk management strategy that's been adopted by many savvy investors. Hedging, in its simplest form, involves making an investment to reduce the risk of adverse price movements in an asset. Think of it this way: you're investing in a protective barrier for your investments. The barrier doesn't stop the price of your asset from falling, but it can help lessen the blow if it does. So hedging is like an insurance policy. It won't prevent a negative event from happening, but if it does happen and you're properly hedged, the impact of the event is reduced. Now that we know what hedging is, let's delve a little deeper into how it works. Hedging is a strategy employed to mitigate the risk of unfavorable price movements in the market. It involves taking an offsetting position in a related security, such as a futures contract. To put it simply, it's like purchasing an insurance policy for your investments. Let's take an example to illustrate this concept more clearly. Consider a farmer who grows wheat. This farmer knows that his income depends on the price of wheat when it's time to sell his crop. If the price of wheat falls, he stands to lose money. In order to protect himself against this potential loss, the farmer can sell a futures contract. A futures contract is an agreement to buy or sell a particular commodity at a predetermined price at a specific time in the future. So, in this case, the farmer is agreeing to sell his wheat at a certain price at a future date. Now, if the price of wheat does indeed fall, the farmer will lose money on his crop. However, he will make money on the futures contract. This is because he has the right to sell his wheat at the price agreed upon in the futures contract, which is higher than the current market price. On the other hand, if the price of wheat rises, the farmer will make more money from his crop. But he will lose on the futures contract, as he is obliged to sell his wheat at the lower price agreed upon in the contract. So you see, whether the price of wheat rises or falls, the farmer is protected. His losses on one side are offset by gains on the other. This is the essence of hedging. It's not about making huge profits, but rather about securing consistent returns and protecting your portfolio from major losses. It's about creating a balance that helps you navigate the unpredictable waves of the market with a little more certainty and a lot less stress. In essence, hedging is a way to get consistent returns and protect your portfolio from major losses. Like any strategy, hedging has its pros and cons. Let's delve into them. First off, the benefits. Hedging can be a lifesaver in volatile markets. It provides a safety net, reducing the risk of significant losses. It's like insurance for your investments, protecting you when the market takes an unexpected turn. Moreover, hedging can lead to more consistent returns, smoothing out the peaks and valleys of your investment journey. But it's not all sunshine and rainbows. Hedging also has its downsides. One of the main drawbacks is that it can curb your profits. When you hedge, you're essentially betting against yourself, which can limit your potential gains. Additionally, hedging is not a simple strategy to implement. It requires a deep understanding of the market and the ability to anticipate changes. In conclusion, while hedging can limit your losses, it can also limit your gains. It's a delicate balance that requires careful planning and strategy. So, who should consider using hedging strategies? Well, let's delve into it. Hedging is particularly beneficial for investors with a high risk tolerance. These are the individuals who can stomach the fluctuations of the market. They're more concerned with limiting potential losses rather than chasing windfall profits. Hedging strategies are also a solid choice for businesses that are exposed to certain risks. Imagine a company dealing with foreign clients. They're constantly at the mercy of currency fluctuations. Or consider a business that relies heavily on a commodity. The unpredictable nature of commodity prices can make budgeting a nightmare. For these businesses, hedging can be a lifesaver, providing a buffer against these uncertainties. However, let's be clear. Hedging is not a one-size-fits-all solution. It requires a good understanding of the market, a certain level of skill, and a readiness to sacrifice potential gains for the sake of stability. In conclusion, hedging is a valuable tool for managing risk, But it's not for everyone. It requires knowledge, skill, and a willingness to sacrifice potential gains for the sake of stability.